All right, so in this video, I'm going to talk a little bit about Federal Reserve monetary policy tools. So there are a few main tools that the Federal Reserve has to implement and affect monetary policy. So the first one I'm going to talk about is the discount rate. So for the discount rate, this is the interest rate that depository institutions can borrow from the Federal Reserve. So if you remember from a prior video that I had, the Federal Reserve is sort of a lender of last resort. And so banks and financial institutions can borrow from the Federal Reserve. And basically, if you are looking at these depository institutions and borrowing from the Federal Reserve, the discount rate is the rate at which they can do so. It doesn't have to be a last resort kind of a situation, but they can borrow from the Federal Reserve. Now, I have listed on here, this is perhaps to some extent somewhat of a poor instrument, at least in my opinion. And the reason why it is perhaps somewhat of a poor instrument is basically because although the Federal Reserve can control the rate at which it lends funds to depository institutions, it can't make them borrow per se. So, although the Federal Reserve could perhaps change what that discount rate is, depository institutions don't have to necessarily borrow, and so that isn't necessarily as effective at producing the outcome the Federal Reserve is looking for in terms of inducing market activity to produce the outcomes that they want, perhaps. Reserve requirements. The reserve requirements is the percentage of each dollar deposited uh, that must be kept on reserve. So normally what happens when you deposit money in a bank is the bank takes that money and they pair it with a whole bunch of other depositors' money, and then they lend it out to somebody who needs the capital, and the bank then receives interest from whoever they lent it out to. And then from that interest, they make a profit, but they also pay you, the depositor of the money, interest as well. So basically, you deposit, the bank packages it all together, they lend it out to somebody else. Somebody else pays interest back to the bank. The bank takes a cut from that, but they also give a cut to you, the depositor. That's why you get interest in your savings account, or if you have an interest yielding checking account, that's why. So for the reserve requirements, though, basically the idea is this is specifying the percentage of each dollar that's deposited that the bank has to keep on reserve to ensure that if a bunch of people show up and want to pull their money out on a given day, the bank has enough money to pay it out. So they can't lend everything out. They have to keep some of it on reserve. So the reserve requirement specifies how much. How much do they have to keep it on reserve? So the Federal Reserve can change that. So if the Federal Reserve wanted to have less money floating around in the economy, what they could do is they could boost the reserve requirement and basically say, okay, now financial institutions like these banks have to keep more on reserve. They cannot lend as much out, and therefore fewer people are going to be able to borrow. There's going to be less money available to borrow. If they do borrow, it's going to be a higher rate because they're competing more for those funds because there's not as much money available because banks have to keep more in reserve. So if the Federal Reserve increased the reserve requirement and shot that up, then basically what that would mean is it would tend to contract the money supply that's available for borrowing and spending, and that would tend to diminish economic activity. Um, However, the problem with that is if the Federal Reserve specified, hey, the banks now have to keep more on reserve, here's the problem. The banks have been lending money out based upon the current reserve requirement. If tomorrow the Federal Reserve says, well, hey, you used to have this percentage that you had to keep on reserve, now you have to keep a lot more in reserve. Well, where's the bank going to get that? I mean, they've been lending this money out. They don't necessarily have that. So where are they going to get it? So this would actually create a bit of a problem for banks if the Federal Reserve changed this and forced them to do it rapidly. Um, and if the Federal Reserve lowered the reserve requirement, all of a sudden the bank would have a bunch of money that they can conceivably lend. But again, if they lowered it and now the bank has more to lend, but now the banks are thinking, well, the Federal Reserve is going to raise it at some point later. Well, the bank might be a little bit reluctant to lend it all out because they're thinking, well, should I really lend this out when I might have to keep it on reserve later when they change things again? So ultimately, this is perhaps not the best tool for the Federal Reserve. They can do it, but it's going to create kind of some significant problems for the financial institutions, the banks, and things that are having to maintain these reserve requirements. So it's not necessarily something the Federal Reserve is looking for in terms of an outcome. You know, they want to change what's happening in the economy in order to manage the monetary policy. They don't necessarily want to create a whole bunch of chaos in the banking system. So from that standpoint, it's a tool that they have, but it's not historically one that gets used as much because of that. That brings us to open market operations. This is when the Federal Reserve engages in the purchase or sale of securities in the open market to affect the volume of depository institution reserves, and a little bit of a black box in the sense of until disclosures kind of come out and things like that about what the Federal Reserve's balance sheet looks like. I mean, technically, you don't necessarily see exactly on a day-to-day basis every last little thing that they're doing. However, at the end of the day, they do announce what they're trying to achieve. So even if you don't know exactly the ins and outs until a little bit later of exactly what the open market operations were, until later when you start looking at the Federal Reserve's balance sheet and looking at their documentation and things like that, and you have a better idea what they did at that point. But you do know what they are trying to accomplish, and they will announce what their target is. So this is basically going there. You are going to know what their target is. You are going to know what objective they're trying to achieve. And this is basically the federal funds rate. So when you talk about the federal funds rate, and the Federal Reserve is going to, let's say, raise the federal funds rate. Basically, what they're going to do when they want to raise the federal funds rate is they want to actually diminish the amount of money that is available in the economy, which would then cause the rate to go up. And so basically, in order to diminish the amount of money available in the economy, what the Federal Reserve will do is they will sell securities that they have on their balance sheet in exchange for cash from investors. And so now, by doing this, the cash is coming from the investors. There's now less cash available in the economy. And if there's less cash available in the economy, the rates are going to go up. Another way to look at this from bond valuation perspective is if the Federal Reserve dumps bonds on the market, there's a greater supply of those bonds on the market. And if there's a greater supply of those bonds in the market, the price of those bonds should go down. And if the price of the bonds should go down, the yields on the bonds should go up. Congratulations, we raised the rate. Okay. So if the Federal Reserve wants to raise the rate, that's basically what they do. They sell bonds in the market and it produces that effect. Now, if you're wondering, where did they get these bonds that they're selling on the market? How did they get those? And generally, they're most of the time dealing with some form of treasury securities for the most part when they're doing this. Well, where they got it was when they were trying to lower rates. So when they try to lower rates, they want to have more money in the economy. And with more money in the economy, then the rates associated with that go down because there's a larger supply of money. And so because there's a larger supply of money, the price of money, the interest rate goes down. So the way that they do that is by buying treasury securities. So basically they create money and then they issue that money in exchange for those treasury securities. They put money then into the economy by buying these treasury securities. Presto, we now have more money in the economy. Now, when they did that, if you think about this from a bond valuation perspective, they bought a whole bunch of bonds. They increased the demand for the bonds because they're buying all these bonds. So if they're increasing the demand for all those bonds, the price of the bonds is going to tend to go up. And if the price of the bonds tends to go up, the yields on the bonds are going to go down. Congratulations, they lowered the rate. Okay. So basically, with the open market operations, what's going to happen, even if you don't know exactly, on a day-to-day basis, which things they bought or which things they sold, basically what they're doing is they're affecting the money supply by engaging in the financial markets. So, and that's why it's called open market operations. They go out there and they interact with the financial markets, either buying or selling, depending on which direction they're trying to get the interest rate to go, until they get the interest rate to go where they want it to be. And so essentially, from that standpoint, they basically just engage in market activity until the interest rate becomes what they want. And so from that perspective, they can just keep going until they get the interest rate that they have established as the target. Now, for the most part, they're going to have a lot more influence on short-term interest rates as opposed to long-term. Because long-term is going to be a lot more influenced by what people assess to be the economic prospects of the country and the economy, and et cetera. That's not to say that they can't impact the long-term rates. They definitely can. But they tend to have a bigger influence on the shorter-term rates. And so shorter-term rates tend to move around a lot more than the longer-term rates do. Okay. So margin requirements. So margin requirements on the purchase of stocks and bonds. This is the percentage of the market value that cannot be purchased on credit. And for the most part, I don't think this has really been used or changed since like the 1970s, I think. But basically, the idea behind this is that they can specify the percentage of the market value that can't be purchased on credit. Now, the reason why they haven't used this a whole lot since the 1970s is basically because it's just too easy to get around. So let's say the margin requirement is 50%. So what that means is you have to put up 50% as an investor when you want to buy the stocks or bonds. If they had the margin requirement at 70%, this would mean that you would have to put up 70% of the money. You could borrow the other 30%, but you would have to put up 70% if the margin requirement was 70%. Okay. Now, the note that it's just too easy to get around is related to this. At this point, investors could perhaps do something like take out a home equity loan and then use that money to buy stocks or bonds, right? Now, in that case, you would totally be using, in reality, margin or borrowed money to invest in stocks or bonds, but it's not going to be subject to this margin requirement because the margin requirement is looking at what's happening in your brokerage account. And in that scenario, as far as your brokerage account was concerned, you just piled money into the account. You have cash, right? Your brokerage account is none the wiser to the fact that you borrowed money against your house to do this. Side note, it's not a good idea to borrow against your house to go pile it into the stock market or bond market. Okay, that's just not a good idea. So don't do that. But people could do that, and they can do that, and they could borrow in other ways, and then take that cash and put it into their stock brokerage account or bond account, whatever. Basically, they can invest it. So it's just too easy to get around. So as a result, for the most part, the Federal Reserve hasn't done a whole lot with this. But one of the things that is worth noting is that investors do tend to use margin more heavily before perhaps market crashes or new market peaks. Basically, there tends to be a bit more of euphoria. And so people tend to be like, wow, everything's going well. I should pile all this money into this and I can make so much money with this and things are going to be great. So if you start seeing more people using margin or talking about using margin or things like that, that's a little bit more of a concerning sign. Now, as a historical example, it was 10% in 1929. 1929 is, of course, when the great stock market crash started. It was kind of kicked off the Great Depression and so forth. And of course, there were some other factors there too. The government engaged in some interesting tariff activities and so forth. You can look up Smoot-Hawley tariffs and so on that kind of happened. That was a few years later, but it contributed to what went on with the Great Depression. But the margin requirement was 10% in 1929. So let's go back to the definition here to make sure you understand what that means. So the margin requirement is the percentage of market value that cannot be purchased on credit. So if the margin requirement is 10%, that means you can't purchase that last 10% on credit, which means you could borrow 90% on credit and you only had to put up 10. So if you only had to put up 10 and you borrowed 90, well, that's just a recipe for a bad outcome if you're talking about stocks and bonds. So let's talk about why that's a recipe for a bad outcome. So if I buy a share of stock for $100, if the margin requirement was 10%, I can put up $10, borrow $90, and buy my $100 share. Now you think, well, okay, so why is that a problem? Well, here's why that's a problem, okay? The reason why that's a problem is if the stock drops 10% from $100 to $90 a share, guess what? I still owe $90 because I borrowed $90 to buy this. And my equity, my investment is gone. I no longer have any equity. I'm wiped out. So the stock dropped by 10% and everything I had put into this is completely obliterated. Okay? Which is incredibly bad, obviously, because stocks can drop by 10%. That can happen, right? So they can drop by a lot more than 10%. That can definitely happen. There are all kinds of historical examples of that happening. So from that perspective, basically when the margin requirement was 10%, one of the contributing factors to the stock market crash was a lot of people were buying on margin and you had margin requirements that were like 10%. So if you have the stock market and let's say the stock market as a whole drops by 10%, well, when it drops by 10%, all these people that bought on that kind of margin, they're basically wiped out, which means their account positions are going to be closed. Probably would have been closed a little bit before then, but basically people are wiped out. The account positions are going to be closed, and the things are going to be dumped on the market because the brokerage firm has closed it out. So you're going to sell it. So when all of these sales occur, guess what? Price is going to drop further. When the price drops further, more people that had margin investments, their investment has been obliterated because now the stocks have dropped past the point at which they had equity. So now more things are going to get dumped on the market, more declines, and so forth. And then that's part of why the crash occurred, is because of excessive use of market. It's not the only cause, and I'm sure there are all kinds of other, more complete explanations. But it was, I think I would argue, it's a contributing factor that excessive use of margin was a problem. So from that perspective, generally speaking, because it's too easy to get around at this point, the Federal Reserve doesn't use that as a real active tool. So from that perspective, if you look at these tools, basically discount rate, not the best tool, because the fact that although they can certainly change it, they can't force banks to borrow. Reserve requirement could lead to some real headaches in the banking industry and chaos, and challenges trying to adapt to it and adjust and get back to whatever the requirements are. That's not a real advantageous side effect. Margin requirements, too easy to get around. They can definitely do it. So that kind of leaves us with open market operations, which really, from an economic standpoint, makes the most sense, because basically the Federal Reserve participates in the market until they get the outcome they want. And so that is actually the most powerful tool, I would argue, that they have from a monetary policy standpoint, is the open market operations. They can essentially engage in marketplace activity until the federal funds rate is what they want it to be. And so from that standpoint, that's why I have it in bold there. That's typically the one that people focus on the most in terms of Federal Reserve policy. They announce what they're trying to accomplish in terms of, they'll announce the Fed funds rate, and they'll basically say, we want to have this particular Fed funds rate. And what they're telling people is, we will either buy or sell the securities in order to try to make sure that the interest rate that we're measuring here is achieved. And so they basically go out there and they buy or sell that. Now, as kind of a note here, when you're looking at what the Federal Reserve is doing, it's important to be thinking about what the Federal Reserve is communicating. So if the Federal Reserve is communicating, hey, we are going to raise the Fed funds rate, what they're basically saying is, you know what, we think we need to pull more money out of the economy. That's basically what we need to do. We need to pull more money out of the economy here, and kind of slow things down a little bit. And if you go back to the video that I did about essentially kind of the mandate of the Federal Reserve and so forth, basically they're looking at things like unemployment and stable prices, or inflation, in other words. And so when the Federal Reserve announces that they're going to raise rates, what they're basically communicating is they're more concerned about the risks of what's going to happen with inflation than they are about what's happening in the labor market. And so they're kind of thinking, you know what, I think inflation might be getting a little bit too high. We need to raise the rates, pull some money out of the system. Inflation can be defined as too much money chasing too few goods. So if you have too much money chasing goods, we raise the rates, we get less people borrowing and spending, less money chasing goods. This should help to address the inflation. So when inflation is high, the Federal Reserve tends to raise the rates to get rid of it. On the other hand, if inflation is not very high and unemployment is higher than desired, then sometimes the Federal Reserve will lower rates in order to promote more economic activity, more economic growth, which hopefully will help with the labor market and lead to more employment and so forth. And ultimately that will tend to eventually lead to more money chasing goods. But along the way, basically you've stimulated the economy and hopefully promoted economic growth. You've gotten more employment. And at some point later, probably we'll have to raise the rates again in order to deal with the inflation. But that means you need to pay attention to what the Federal Reserve is communicating. If they're talking about lowering rates, that basically means they're more concerned about the economic strength and the employment aspect of things than they are about inflation getting out of hand. If they're raising rates, they're a little bit more concerned about the inflation situation, and they don't think the labor market needs, more support, basically. So kind of pay attention to, what are they talking about? Are they trying to raise rates, in which case they're trying to slow things down in the economy, diminish some inflation? Are they lowering rates, in which case maybe they're a little concerned about economic weakness and trying to spur more employment? They don't think inflation is much of a problem. What they're talking about doing tells you a little bit about what they're thinking. So kind of pay attention to Federal Reserve communications. All right, hopefully this video has been helpful. Thank you so much for watching, and have a great day.